There is a number floating around the financial press right now, $1.75 trillion. That is the rumored price tag for the SpaceX IPO, but rumors don't help you make decisions. The only thing that matters is the math inside their audited S1 filing. This table breaks down the confirmed S1 figures against the public reports. When you isolate the actual confirmed revenue from their Starlink division, it sits at $11.4 billion. Compare that directly to the $1.75 trillion valuation target down at the bottom. To figure out if that gap makes financial sense, we have to translate that massive price tag into standard market multiples. We need to see exactly what you are paying for at that level. Determining if this valuation holds up requires testing the S1 data against standard financial benchmarks. We have to look past the engineering milestones and analyze the actual cost of entry. The cleanest way to measure the cost of entry is a metric called price to sales. It tells you exactly how much you are paying for every dollar the company brings in. This bar chart compares SpaceX's target multiple to the broader tech market. At $1.75 trillion, they're asking you to pay roughly 94 times forward sales. Look at the sheer height difference here. Palantir is the most expensive large-cap software name, and NVIDIA trades near 21 times. SpaceX towers over both of them. This data table shows the critical context behind that multiple. Every other mega cap on this list is profitable. SpaceX is running a $2.6 billion operating loss. This is the core trade-off. Buying in means paying a record-breaking premium to subsidize a money-losing startup that has yet to prove it can reach self-sustaining profitability. To understand these losses, we have to treat the SpaceX ticker as a composite of two distinct businesses with incompatible financial profiles. This chart from the S1 filing breaks down their 2025 operating income by segment, and the split is stark. On one side, you have Starlink. It is a brilliantly profitable internet provider, pulling in $4.4 billion at a 39% operating margin. On the other side, you have the AI and XAI unit. This segment lost $6.4 billion over the exact same period. When you net those two forces against each other, the AI operations drag the entire consolidated company down to that $2.6 billion loss. Buying the IPO provides exposure to a proven winner, but it forces you to pay for the operations of an unproven cash furnace. Let's isolate that profitable engine for a moment. Starlink's physical hardware and its user base. This line chart tracks their subscriber growth, and it is the strongest fact in the entire bull case. Their user base practically doubled in a single 12-month window, crossing the 10 million mark by early 2026. But we have to weigh that growth against a metric called ARPU, or average revenue per user. It measures a company's pricing power. The S1 reveals a hidden caveat. Over that same time frame, Starlink's revenue per user dropped significantly, falling from $99 down to $66. They are acquiring users faster than anyone in the industry, but they are doing it by cutting prices. That tension raises real questions about their long-term profitability ceilings. Maintaining that growth takes an unfathomable amount of physical infrastructure. Satellite constellations and frontier AI data centers are highly capital intensive. These gauge charts compare how much of a company's incoming revenue goes directly toward capital expenditures, or Capex. Established tech giants like Microsoft and NVIDIA are capital light. They comfortably fund their own growth, spending around 10 to 20% of their revenue on Capex. SpaceX sits at 111%. They spend more to build out their networks than they bring in through the top line. When a company outspends its total revenue, it cannot self-fund. It has to continuously raise money from the outside to survive. Funding a burn rate like that introduces severe long-term dilution risk. If you hold the stock, your ownership gets diluted every time they print more shares to keep building. If the math shows operating losses and a massive capital burn rate, how do the bankers justify a $1.75 trillion price tag? This chart applies a sum of the parts valuation method. It breaks down what Starlink, the launch business, and the 8 alienates are worth independently based on market multiples. Even if we apply the most aggressive, optimistic models to every single segment, the combined pieces only reach about $1.5 trillion. That leaves a massive, visible gap between a realistic valuation and the actual asking price. The asking price requires paying roughly $1 trillion premium. That premium isn't tied to today's fundamentals. It is an option value based entirely on faith that Starship and AI will eventually dominate. The S1 data clarifies the actual investment profile. SpaceX functions as a cash-hungry infrastructure builder with significant capital needs and ongoing operating losses. This IPO fits a very specific profile. It is for long-term allocators with high-risk tolerance who believe the 2030 returns will vastly outweigh the near-term dilution. If you are a value investor looking for safe tech harbors or dividend potential, this is not the right vehicle for your capital. And practically speaking, direct retail allocation is capped at around 30%. Many individual investors are going to be boxed out of the primary offering regardless of their intent. Buying the ticker directly means absorbing the total risk of the XAI cash furnace in exchange for a piece of the long-term dream. But there is an alternative strategy. You can capture the financial gravity of the IPO without having to buy the expensive, unprofitable SpaceX ticker. This scatter plot maps out the public Proxy Playbook. These are publicly listed companies whose stock prices react directly to SpaceX's moves. Look at the high exposure quadrant on the right. These are the companies that actively benefit from the SpaceX ecosystem. This table breaks down their exact roles. NVIDIA provides the GPS for the data centers. Goldman Sachs underwrites the deal. They capture SpaceX's massive capital spending as their own revenue. Conversely, look at the bottom rows. If SpaceX successfully capitalizes this deal, their listed rivals, like Rocket Lab and AST Space Mobile, will face immediate pressure. You don't always have to take $1 trillion leap of faith. Sometimes the smartest play is to supply the builders rather than paying top dollar for the house. For the full analysis, visit marketdecode.ai, subscribe so you don't miss tomorrow's decode.